Welcome to the results for Grit Real Estate Income Group for December 2020 half year. Leon and myself will be taking you through the presentation and really just giving you the high-level highlights from a group perspective and what the group has achieved successfully and what the core focus of the group will be over the next 6 months. So if I can start you on the highlights, which we'll go into more detail during the presentation itself. And if I can just ask for the highlights page just to be shown. So from a highlights perspective, what needs to be noted is the performance. We have seen a just over 3% increase in total income producing assets. We'll go into a bit more detail around the valuations themselves, as well as specific valuations increases around hospitality and forex movement. We've seen a 6.3% growth in NAV, which again has been driven from the consistency of the valuations and some other parameters which Leon will go through in his presentation. One of the core focus areas is obviously the vacancy rate. We have seen an increase of just under 6% to over 8% in the vacancy. However, as will be shown in the presentation, this has been predominantly driven by the retail sector specifically. And what we have seen is we've seen a just over 8% growth in the net operating income. And whilst we've seen a weakness in revenue, from a group perspective, we've seen an unbelievable cost control optimization and the ability to control the cost base of the group, which has obviously seen a production of the 8% growth in this particular number. We will be spending quite a bit more time on the actual collections. So one of the main focus points under COVID is the performance of the underlying tenants and the ability to collect. And this will go specific to sector classes themselves. We have achieved an under 50% loan to value. Leon will also be touching on the loan to value. And we're obviously targeting closer to 45% in the short to medium term. We've been able to successfully recycle under $40 million worth of assets, with partial disposals of both Anfa and Acacia, and asset recycling initiatives will continue into the next 6 months, and really around the resumption of the dividend. So even though we've resumed the dividend on a smaller basis, there is a key sort of building block on how we're going to go back to resuming dividends as per usual in relation to quantum and the ability to pay a quarterly once-off distribution should certain parameters be achieved. And we will be touching on that during the course of the presentation. So if I can take you into the first slide, really under the highlights slide, and if you can move that, really around what we are focusing on as a management team and board and what we are really looking at as a basis of what we've set the business up. So again, the underlying property performance and performance of the existing portfolio, the collection focus, which I will be touching on in detail, the cost control, and protection of the underlying asset management initiatives around the existing portfolios is really key to us. That goes in line with the addressing the rising vacancy to 8%, which is predominantly driven by the retail sector. A key focus is on the strength of the balance sheet and group liquidity. And obviously that will be looked at in conjunction to extending existing debt facilities, the valuations of the portfolio, really looking at the cash reserves of the business, which goes into the asset recycling. The resumption of dividend I will and have touched on and will go into the end of the presentation. The leveraging of what has been probably a 2.5-year project for ourselves is the premium listing and the Guernsey redom, and the importance of that to ensure that we get some form of index inclusion going forward. And then really just giving you a bit more detail around the pipeline that's been historically announced, and also what pipeline we'll be pursuing and the funding attached to that pipeline and how we foresee funding that. So if we could just move on into the really around the COVID impact and what we see as the collections, which impacts the actual distribution, which obviously impacts the level of distribution going forward, is that, again, the more resilient sectors being office, corporate accommodation, and light industrial, we've seen over 100% collection in most of those sectors. Again, on the retail, we have seen strong collections, but we're not quite where we need to be. And up to sort of December, we've seen strong hospitality collections, but we are monitoring that quite closely going forward, which accounts for approximately just over 90% of the collection rate up until the end of December. So just on the next slide, specifically around the valuation movements. So the valuation movements are obviously very important in relation to the loan to value, in relation to the performance of the underlying various sectors. You would have seen a stabilization of valuations in relation to office, light industrial, corporate accommodation. That's been driven by the collections themselves, as well as the lease renewals that we've been able to achieve, and also just the underlying performance of those particular tenants in light of what we've seen as fairly distressed times over the COVID period. Hospitality has an unusual increase of 11%, but can be predominantly explained by the FX movements, specifically the euro movement to the dollar, which is the majority of that percentage increase. And it's obviously the strengthening of the Forex, but there is some form of fair value movement, and that's the underlying CapEx that's been done on that particular asset. So an overall just over 2% increase in the actual underlying portfolio itself. We've obviously seen a retraction on retail as we continue to renew leases, as the vacancies continue to increase over that particular sector itself. But from a valuation perspective, and the fact that our valuers have lifted the material uncertainty on a lot of these asset classes that we've seen, just shows a stabilization under the COVID performance that we've seen in the portfolio over the last 6 months. As I continually highlight, just over 52% of our portfolio and those particular asset classes, really probably country agnostic, have proven to be very resilient. The cash collections have remained largely unaffected, and the valuations have remained largely unaffected. I will touch on the hospitality sector and the retail sector in the up and coming slides. One of the major work streams of our management team is around vacancies. What you will see from this slide, the 5.9% to the 8% has been predominantly driven by the retail sector. So what that was very important is that that is really sector specific. What has been very, very interesting to see and very positive is that the other sectors have not driven the vacancy rate. So the management team is very focused on the diversification out of retail, and secondly, around some initiatives around repurposing some of the retail in the portfolio itself. So that's what really the predominant driver is around retail. And Darren, if I can just ask you to go to the next slide. So I think what's important under this particular slide is that even though retail has been a strong driver of the vacancy uptick, the assets in Mozambique and Kenya from a cost of vacancy are actually quite small. So you'll see that we've detailed the total monthly cost of those vacancies. So they might be pushing up the percentage, but the actual cost of vacancy is quite low. Morocco specifically and Zambia vacancies have been driven predominantly by COVID. So one, there's been a slow take-up or extended take-up of fit-outs, tenants actually occupying premises. There's been the inability of retailers to travel into these jurisdictions to negotiate on these retail sites specifically. So even though we've had quite a bit of interest around Morocco, specifically around the redevelopment of Anfa and or some of the assets in Zambia specifically, we've had the inability of these retailers being able to travel. So we believe that that uptake will come as soon as the borders open around these two particular sectors and obviously countries specifically. Hospitality is one of the key drivers and makes up quite a large percentage of our asset diversification and obviously our investment base for Grit itself. Again, just reiterating that we are very much counterparty focused, so strength of underlying tenant. We sit with both Beachcomber and Luxor Mauritius that have had major government support. They have both recently had approvals from the Central Bank of Mauritius, which has assisted with regards to their cash flow requirements. And that is actually specifically, if you look at our collection rates around hospitality, is that both groups have resumed rental repayments from the 1st of August. and Lux obviously from September, and Lux are fully paid up till 31st of December. So you'll see that even though that this government funding has been slow on the take-up for these particular hospitality groups is now in place. And that's one of the drivers for one, paying a distribution now, and also paying a slightly lower distribution because we are waiting for those cash payments to now come and reflect within the group itself. Club Med, again, very strong hospitality group. Club Med has received significant funding and assistance from the French government. We've been able to ensure that the rent has been fully paid up till the 31st of December, which is a sterling result for the team, as well as the fact is that we've been able to remove the hardship clause, which has been quite important for the valuation of the asset. And we've now resumed 50% minimum rental repayment from Club Med itself. So we don't see any challenges in the medium term or long term with these particular groups, even though we have had to see some cash flow reprieve in the short term, which is obviously driven around some of our dividend distribution and decisions around dividend itself. So again, just to basically highlight again, Grit's investment strategy, multi-sector, multi-geography. That has obviously proven to be a very good investment strategy for what we've seen that's come over COVID over the last couple of months, actually probably almost a year now. What is important by this slide is what we've done, and this is a slightly different slide to what we've normally presented, is we've actually shown Grit's economic interest in each of the sectors and specifically the geographies. And you'll see predominantly from this, because of the diversification and the partial disposal of ANFA, our retail exposure has come down. And one of the main messaging that we've put out historically and continue to do so is we don't want any retail in the up and coming pipeline of Grit, as well as the fact is we do want a further diversification out of retail. So one of the key aspects which the team has done, which will be shown through this all of these slides, is the lease renewals. So there is a slide that shows a number of leasing activity that's taken place. And obviously around the fact of the lease renewals coming up. You'll notice that Cosmo Mall and some of our retail in Zambia comes up for lease renewals. And those leases that are terminating are a key focus of the team. So we might not be seeing vacancies coming out of those lease renewals, but we have historically seen rental pressures that have come out of that, which has been attributed to the drop in valuation on the retail sector specifically. But this highlights the continuous leasing activity that the team is driving. So I think just to reiterate that 15 tenants make up just over 70% of our sort of revenue stream. What is important around that is the sort of multi-geography, but also multi-sector. That multi-sector has proven to be very resilient because we have seen sectors that have actually thrived over this period. Sectors around communication, sectors around financial services, that's continued. One of the key tenants that has been in the press of late, which is our third ranked tenant, is Vale. And Vale specifically is quite a key asset for Grit. So you would have seen some announcement around Vale looking at disposing of their mine in this particular region that we have the corporate accommodation. But it's really important to highlight a couple of key aspects around Vale themselves. So one, we have a lease that still remains in place for 3.5 years. That lease is legally binding on Vale. Again, they wouldn't relinquish on that lease. It's quite small in their cost-saving initiatives, but they have committed to seeing that lease out. However, what is still important is that they are investing 2.5 billion in their capex spend in this particular region. So it's definitely not their intention to just exit this particular asset. And we see a need for this corporate accommodation in various spheres, whether it's a Vale into the future, whether it's the acquirer of this particular mine, whether it's a repurposing. But that gives the team 3.5 years to be able to work on a firm asset management solution for this particular Vale exit out of Mozambique specifically. So as I alluded to earlier, I'm not going to spend too much time on this slide, but that slide specifically shows the leasing activities. And even amidst the COVID inability to travel, access the actual sites, the tenants themselves, One, we have optimally been able to get people into these locations, and we have teams on site, and we've been able to negotiate just over 36,000 square meters of space over this period of 6 months. So if I can hand over to Leon, just to touch on the financial review, and then I'll go through the balance of the presentation. Thanks, Leon.
Thanks, Bronwyn. Just to quickly give you a snapshot of the highlights. So there's the resumption of dividends at 1.5 cents per share for the 6-month period. In terms of the gross rental income, you'll see we're relatively flat in terms of the gross rental income. There's a further breakdown of that a little bit later. Profit from operations increased 19.7%. This is on the back of a very measured cost savings approach, which has been very successful for the 6 months. In terms of adjusted EPRA earnings, we are down a significant amount of 44% to 3.16 cents. The main driver of this is the previous period when we had our share in the profit uptake on some of the pre-development funding which we did, which was about $3.6 million. In terms of distributable earnings, down 29% to 3.88 cents. And the EPRA cost ratio, which is the result of the cost measures that we've put in place, 14.3%, down from 18.6%. The NAV evolution I'll go through just now, but total income producing assets are up 3.1%. Weighted average lease expiry, 5.2%, 5.2 years, as one mentioned earlier, the successful leasing activity. EPRA vacancy, the increase there of the 8%, which is something the management team is working tirelessly on, which as a result in the property valuation impact also down to 49.3% from 50.2%. So just breaking down the movement in our net asset value. So in total, the property performance, you'll see the retail was down in valuation, which impacted us 4.8 cents. In total, the property portfolio was down 2.1%, but that was obviously offset by the foreign currency exchange fluctuations on those properties, which is 2.5 cents up. Another increase that we did have was the sale of the minority stakes in both Anfa and in Acacia, which increased our net asset value by 4.5 cents. And the other contributing factors, obviously, the attributable earnings and some non-cash items, which were movements in the provisions. On the next slide, you'll see a detailed breakdown just of movements in revenue. From a like-for-like basis, you'll see we're down 6.2% in revenue, predominantly driven by retail, 19.1% down. This is driven by vacancies to a large degree and offset to a degree by the movement of the Moroccan dirham versus the dollar, which was positive, as well as lease cancellation fees, which we recovered in this period. One thing that was quite positive out of this is that the negative movement in the revenue has been offset by a large degree from the savings from the actual operating costs, which the team has been working exceptionally well on. So on an NOI basis, like for like, we're up 0.9%. And then just the full year impact of last year's acquisitions, it's now contributing to an increase in NOI of $2 million, or around 8%. As mentioned before, the gross income or income producing assets has risen to 849. A large component of that has been the acquisitions that have come through, the capex spend, as well as the valuation movements, but also the movement in the euro versus the dollar. Just key items to highlight there is the operating cost ratio. You'll see 2.1% in the previous comparative period, which has dropped to 1.6. In total, we've managed to get the admin cost line item down from around 10 million to about 6.7 million over this 6-month period, which has been very encouraging. Obviously, the key items for us is the interest cover, 2.1, which is still fairly healthy. And then the net euro exposure, which is one of the items which does drive LTV as well as net asset value. It's slightly negative on the LTV because we have a high proportion of euro debt versus asset value, but that does have a positive impact on net asset value. In terms of our near-term targets on LTV, we remain focused on getting the LTV to 45%. And that's one of the items which is discussed later in terms of the reason for keeping the dividend at a modest 1.5 cents. The asset recycling initiatives, the new funding notes that we intend to publish in a short period of time, as well as the accretive asset acquisitions that are still in the pipeline, will contribute positively to that. Asset valuation recovery is something that we can't really predict too much with the onset of COVID and the continuing second wave of COVID, but we do see a positive valuation coming through once that period comes to an end. In terms of our debt expiry, at this point in time, we've got some debt expiries that come up in the next 12 months. We've made significant progress with the financiers already, and we're targeting to close that in the coming months, well before the maturity dates of February, March, and April next year. We've continued to be multi-banked. The support of the banks has been great, and the two-way communication that we've managed to maintain with our financiers is one of the key strengths of Grit, and will continue to be so. So one of the items which we have raised a provision for in this period is $4.1 million for our PRC Drive and Trading guarantee, which is our transformation partners. This transaction is now up for renewal and renegotiation. We have entered into lengthy negotiations with the PRC. There are still some items which you need to finalize on negotiations. One of them in particular is the notice period for providing cash collateral for this and the extent of that cash collateral, as well as the interest top-up mechanism and the interest increase on that loan. This is something that's very likely to come back to shareholders for shareholder approval once negotiations have been finalized. Just to highlight there, total distributable income from 16.2 million to 11.8. Predominant driver there is the once-off items we had in the previous comparative period, which was the profit share on the pre-funding arrangements that we had. There are transactions that are going to continue on that basis. However, they've been stalled and put on hold for the moment while we're under the COVID period. The other items are just for noting and can be seen in detail in our RNS.
Thanks, Leon. So just to go to obviously the investment and pipeline slide. Thanks, Darren. If you can just go onto this. So I think what the importance of this particular slide is just around understanding our thought process in relation to pipeline and investment considerations. And I think we all know in the last 12 months that the world as we know it has changed dramatically. And it's about the effective use of capital now. And ourselves and the board have really been analyzing this particular point. So one, it's around ensuring that we give clear guidance around pipeline deals and looking at pipeline deals in relation to waterfall of funds, the ability to fund these transactions in the light of what we've seen. Key priority is the strengthening of Grit's balance sheets, which goes to the loan to value, the liquidity, the cash that we have access, the ability to access that, the disposal of non-core assets, specifically around the retail sector specifically, and the ability to look at other initiatives around raising liquidity into the business. And what we've done is we've really assessed those pipeline transactions which have been announced previously to say, you know, from a value perspective, from an accretion perspective, from a funding perspective, what do those mean in light of where we find ourselves today from a balance sheet perspective? And this is how some of the decisions have been taken around specific pipeline assets. So even though the two particular assets, being the PwC building and Hawaii building in Ghana, very good tenants, very good assets, possibly something for the future, but not for today, has really gone around the effective use of capital and the ability to fund these transactions. What's happened around Morocco and this particular asset in Sierra Corner, around the ability to now look at this asset in the context of retail plus hospitality, makes it a very difficult asset to price in this market from a risk perspective. However, it must be noted that we will still continue to escalate the ability to convert our particular exposure being ANFA into a retail structure in Morocco. So that work stream has not stopped. However, the looking at this particular asset in the context of that, where we find ourselves today, is quite important. So as it stands, these three assets will not be pursued in the short term. What will be pursued, and the rationale behind it, is that the ability to, one, yield, the accretion to our existing investors around sort of pre-funding development type assets, the fact of the ability to now invest into the healthcare medical sector, as well as the light industrial sector, further investment into that, and the fact that we are in the process of securing very good DFI money for these particular three opportunities. So the cost of funding is good, the ability to secure additional equity providers, but obviously optimally being able to give the accretion back to our existing shareholders. So these three particular opportunities will be pursued. And then just touch high level, we have announced Bolloré and also the Cape Skirring redevelopment. So that is continuing in the pipeline, and the cash has been raised for those two particular assets. So what I thought important, Darren, if you can just go to the next slide, is to really just to touch on the Greer investment. So just so that the audience remembers, the investment into Greer, which Grit just owns 20%, was done on the basis and proviso of the fact that we wanted the ability to link ourselves with a development partner. We wanted the ability to not only to have completed assets with the multinationals, but we wanted the ability to develop for multinational tenants like the American Embassy OBO specifically. We wanted the ability to secure pipeline, so a buying option, the ability to pre-fund into these transactions, which gave us an enhanced return, not just on distribution, but net asset value. So this Greer relationship continues to be a very important relationship. And Greer itself as a business has progressed tremendously over the last couple of years. And if we go onto the slide around the pipeline that sits in Greer today, you'll see that it has exposure into three very large American Embassy corporate accommodation assets, specifically Ethiopia, Kenya, and Mali. It also is in the process of completing the embassy and one of its other retail developments. So not only is Grit operating, but this particular business, which raised upfront capital of $175 million, has deployed it into this very, very good pipeline into the future. So we still have the ability to access this in one form or the other. So this was very important to highlight to our investors. Sustainability is absolutely key for business like Grit. One is the fact that we are in Africa, outside of South Africa. So the impact of a business like Grit on the fact that we can pioneer initiatives into some of these markets with our real estate exposure, and also the basis of having proper footprint and people in these countries are absolutely key. So you'll see that our sustainability priorities have been split around four specific sort of segments. Gender equality is obviously key. Obviously not just the fact that I lead the business, but on other parameters of having a fully encompassed team. And we do boast today that over 42% of the people in our organization in managerial positions are women. So sustainable priorities are a key factor of this business and will continue to be so into the future. So really around what Leon and I have both highlighted is that we have really looked at this distribution. So one, we have resumed distribution because we have seen really positive impacts on our collections, as been demonstrated in the presentation itself. We have also seen a positive impact on reducing the LTV. What we do envisage is we do envisage an additional quarterly dividend in 2021, dependent on being able to achieve the following four items and being able to successfully seek conclusion on these items. So yes, we've declared a very minimal distribution, but the intention is to play a form of catch-up. However, the four key attributes or four key work streams around those are the following. So we need to make sure that our valuations continue to see, one, that they hold valuation and continue to see a slight upliftment valuation. So the LTV is very, very key to get closer to that 45%. We need to continue to see strong rental collections in the hospitality sector specifically, because that's a very large driver of our revenue stream. The drive in trading guarantee restructure is also critical in relation to ensuring that we have the ability to declare that additional once off. And then just the conservative outlook around what does COVID mean? And obviously we've seen the impact in Europe, we've seen the impact across the world. We continue to see an interesting stance and impact in Africa itself, but we will continually, as a management team and board, assess that. So those four parameters or principles are really key to decide do we pay that additional quarterly distribution in the next up and coming months? So really just in conclusion, I think just to reiterate what we have achieved, the listing from the JSE, so the sort of consolidation of the capital structure, the premium listing, as you would have seen, and we actually did a market bell ringing this morning, which was quite exciting on the LSE about the premium step up, and the redomiciliation into Guernsey. So the rationale around tirelessly working on this for 2.5 years was it was very important to get a stock like Grit, which is pretty orphaned from an index perspective, the ability to access the main indices in the UK. Because as is depicted on this slide from the left to the right, the liquidity about having a premium listed business that accesses the main FTSE, the ability to attract fresh capital, the diversification of the shareholder base is really, really key. So we want to use this now as a foundation for the next phase of Grit. And the ability to now leverage off this foundation for our institutional investors to really take this business to the next level. So this was really, really important for us to close this particular work stream, which the team has successfully done over the last 6 months. So in conclusion, and I'm going to open up to questions now, I think what is really important is we have a definitive plan. The management team and board are very clear on our deliverables and actions coming up. And we are really confident around an Africa, ex-South Africa real estate business, diversification asset class, diversification of geography, and proving resilience of the Grit business. So Darren, at that point, I'm going to hand over to you. Thank you very much.
Thank you, Bronwyn. Thank you, Leon. So everybody, we will now open up for questions. As discussed, I think it's probably simplest and easiest if you use the raise your hand function on the Zoom application. Or alternatively, you're welcome to post questions into the chat room area, and we can probably sort of open that up for questions now. And while we do that, Bronwyn, do you mind just quickly discussing about the redom and also our thoughts around Mauritius? You know, so what is Grit's position in terms of operations and effective management, please?
Thanks, Darren. So obviously the importance of the redomiciliation just goes in line with our capital structure and ensuring that we are adequately positioned for inclusion into the main indices in the UK. However, our effective management and the team on the ground, including myself and Leon, we have over 80 people based in Mauritius itself. The intention is to continue to operate out of Mauritius. We have found Mauritius a very good jurisdiction from sourcing of very capable skills in Mauritius itself. We've had the ability to invest in Mauritius itself. We've had good financial support, both from an equity perspective and a debt perspective, from institutions in Mauritius. So the intention is to very firmly remain positioned into Mauritius into the foreseeable future. And again, the redom really just goes in light of the capital structuring, which should enhance liquidity and see all those benefits, which will obviously benefit not just our UK institutional hold, but our entire share register, even those that are holding through the Mauritian Stock Exchange itself.
Great. Okay, thank you. Now we've got some questions on the chat function, Bronwyn. So when we paid an interim dividend last year, we had a few issues on moving dollars around the continent, and there was a bit of a delay on that. Are we seeing that today? And do we have any expectations of that being an issue this time around? And what are our general views on mitigating risk when it comes to moving currency around the continent?
I think I'm going to let Leon touch on that. And I mean, I can just carry on, but I'm going to let Leon start with that answer, please.
So essentially the challenges we had last year was more around the offices being locked down and people having access to actually get to the office at the banks, etc., to actually move the cash. There's a lot of paperwork that needs to be done in the background to the central banks to actually move the cash, which was quite challenging during the lockdown period. To date, we haven't seen material delays in payments greater than 30 days. We continue to move cash between the countries without any issues at this point in time. But just to highlight and remind everyone that we do have the political risk insurance, which does cover us for this eventuality if it ever did come in play, which helps us with the currency convertibility and transferability risk.
Even though we've never had to access that insurance. So over this particular period, which was mentioned now, we also obviously saw challenges out of Mozambique. When COVID hit and the lockdown hit Mozambique, it literally went into lockdown. So the banks went into full lockdown, became a real issue about moving currency. So even though there was a delay, it still was resolved very adequately through our financiers at the time. So we don't see that happening in this period.
Great, thank you. Fine, so I think we will go into the next question. We're seeing a weighted cap rate that's flat over the period. Sorry, I also just wanted to add on to one thing on that thing from last year, Leon. Last year, the currency issue we had was we were right at the onset of COVID. And if you recall in the markets, exchange rates really spiked across all exchange rates versus the dollar, and there was a pure liquidity squeeze. I think what the Fed did subsequently was injected a lot of liquidity, and what we have not seen subsequent is any liquidity crisis across Africa. So I think it was a really peculiar time last year when we saw that squeeze in liquidity. It actually resolved itself quite quickly, but that's what was the driver last year. We're not seeing it again. The next question, the weighted cap rate is flat year over year. So can we talk about what transactions we've seen March 2020 to date? And what are the general trends in cap rates in markets? And if you don't mind, Leon, I'm going to start off by just observing what we've seen in the US markets and actually in European markets is that the spread of cap rates over base rates, so government bonds, is at its highest or at its widest even since the global financial crisis. Now, obviously, we have seen some movements in cap rates globally, but the biggest shock absorber has been the lower base rates this cycle versus the global financial crisis. So that is as a precursor, it sort of explains why cap rates absolute haven't moved as much, but maybe you can get into a bit more of the detail, Leon, on what exactly we're seeing in terms of our valuation cap rates and volumes and transactions in the market.
So you would have seen the risk premium come into the valuations for the June round of valuations. What we've seen now, them being relatively flat. There hasn't been much increase that's actually happened in terms of the risk profiles. What we have seen is it's a function of the actual revenue collections as well as the vacancies within the properties that's been driving it. But from the sort of underpinned risk of properties, that remains fairly flat and should improve over a period of time once we're out of the COVID situation. But I think we just have to be very cautious and very much focused on driving the things that we can change, which is predominantly the letting, getting all the interest that we have received in these assets and the space available, and getting that conversion ratio up in the next coming months. Tenants are still having a little bit of a wait and see attitude and having difficulty to actually go to the properties themselves to assess the properties. But then the volume of interest we've had is improving day by day.
So maybe just to add on to that, Darren, is that we took quite a large valuation hit for June. So it was really based around the valuers, including a material uncertainty around COVID itself. The auditors were very conservative again on valuation. So there was a very material devaluation for June. What we have seen is we've seen that as time has continued, the valuers are now saying things like corporate accommodation, office in some of these segments, light industrial, have actually shown and demonstrated to be resilient. One, we've been able to do lease renewals, there have been very minimal vacancies, collections have been very, very strong, and that's allowed them to remove that material uncertainty clause. So that's where the flattening and the sort of wait and see on these cap rates has come about. So for us, because we work so closely on these valuations, yes, there's a definitive opportunity of pipeline refreshing itself on acquisitions going forward because people are obviously feeling liquidity pressures. So the concept of consolidation, being able to consolidate across the African continent is very interesting at this stage. However, valuations themselves continue to track and obviously remain relatively flat. And as we said, while we had to touch on the hospitality, because that valuation driver was because of the euro movement specifically, not because we saw that huge growth coming up. Sorry, apologies. We lost Darren, so I just want to go into the questions. Apologies for me reading this here. This is a very good question. So considering the intended deleveraging, are you thinking about offering selective co-investment opportunities to your shareholders? So that's actually a very good question. So a lot of our shareholders, which are predominantly one institutional through the UK itself, but a lot of pension funds in Africa, they have got different pools of capital. So they've got equity money, which is obviously an investment in Grit, but they also have direct pools of capital for direct real estate investment. So we are intending on looking at some of the ability to co-invest with some of our existing shareholders, specifically the pension funds. But another important noting point, and it's maybe something we haven't touched on adequately in this presentation, is that Grit has set up a really good base across Africa from an asset management perspective. I mean, we've got over 100 people across these jurisdictions, excluding our partners. So the ability to co-invest with institutional investors who don't have presence in these countries, and the ability for Grit to asset manage, property manage, facilities manage. So we might own possibly 20% of a structure or a 20% of an asset, but we are able to provide the services of an asset management. The benefit to this is the fact is that we can bring in additional fees. So we've already seen some asset management initiatives coming on with the business. We're in negotiation with some of our partners. So really what we foresee for the future of Grit is not just the income revenue line from rentals, but also the asset management revenue line, which is just sweating our current infrastructure and base across the continent. So I see that, Mark, are you asking a question? I just want to see if I can actually... So Mark, are you able to hear me?
I can hear you, yes. Can you hear me?
Hi, Mark. Yes, I can.
Good morning.
How are you, Mark? Good morning.
I'm well. I'm well. I asked two very specific questions. They might not interest everybody. One was about Mozambique and the political situation over there. I missed the beginning of your presentation, so maybe you talked about it. And the second one was the Club Med relationship, how that was evolving, because it was an important part of your strategy before COVID.
Absolutely, absolutely. Thanks, Mark. And I'm going to just swap your questions around. So I'm going to tackle the Club Med, and I'll ask Leon to just update you on Mozambique. So interesting enough, and Club Med is a very important tenant for us, and will continue to be an important tenant. I think we've had the benefit of actually working very effectively with them over this period. So being the fact that we have actually negotiated, there's been no force majeure that's been called. We've actually negotiated an amicable solution for both parties in relation to ensuring the collection of rent up to the end of December, negotiating a partial rent being 50% of their rental till they resume trading in Senegal, specifically in October. So for us, sometimes the sign of a difficult time is how well your partners behave. And I think Club Med and ourselves have done a sterling job to handle a very complex, difficult position very well together. So we see this relationship continuing into the future. Club Med have handled the situation even across all of their assets across the world very, very well. So they are still a very key partner for us. And sort of life after COVID, what we see is a key strategy going forward with them. So if I can just ask Leon just to touch on Mozambique specifically.
So Mozambique has seen sporadic violence in the north of the country. So it's actually north of Pemba where our Bolloré asset lies. It's more in the area of Simba de Praia where the actual works are in terms of the onshore oil works for Total. This is something that we do need to keep a close focus on. It hasn't really expanded itself much beyond that, but this is something that we do keep a close eye on. We're not seeing it impact any requirements in terms of letting space. So there is still strong interest in the new facilities that we are bringing up in the Bolloré warehouse. Phase 1 is completed, and the letting for phase 2 is well underway, with Bolloré having signed a new 5-year lease on that facility about 6 months ago.
Thank you.
Yes, can I add something
Yes.
to that Mozambique situation? Can you hear me?
Yes, I can, Mark.
Yeah.
Clearly.
Just a
Go
further
ahead.
question. Total has announced that they are considering moving all their facilities and logistics to Mayotte rather than staying in Mozambique. Could this be an opportunity for Grit, or is this out of range?
It's not something we've specifically looked at. There is a move to drive some of their staff and to maintain their focus in Maputo for a lot of their staff. We have seen additional requirements from them in terms of office space in Mozambique, as well as the corporate accommodation side. I think we need to keep a close focus on that. But it's obviously something we do pride ourselves in following our tenants' requirements. However, we do have our overlays in terms of country risk and all the other factors, which are our margins of safety before we can actually follow a tenant to any specific area.
But it is a key consideration. And to, just on that, just so you would have seen quite a bit of American Embassy pipeline, especially under the Gateway, the Greer team. So it's also a consideration under the American Embassy. Because again, these are key clients, and ultimately, as you know, Mark, our drive of this business is the counterparties, the strength of the underlying tenants. So it's very important that we look at their needs and see if we're able to fulfill them.
Thank you.
Thanks, Mark.
So Bronwyn, I'm back online. I don't know what happened. My first world internet decided not to work. And I'm not sure if we've addressed this yet, but I think there's a few questions coming through on just the dividend policy. So going forward, I think obviously we've got a fairly low payout ratio right now, and it is linked to our LTV strategies. But the question is, what are we going to see for the medium term in our targeted payout ratio? And, I think, and I'm not sure if you've answered this question yet, but it was tied to asset recycling. So I think, the first element of the question was, do we expect, or what else can we expect in asset recycling? And linked to that, do we think we'll ultimately sell to zero in retail? And ultimately, after those have all take place, what is our sustainable dividend policy and target for a payout ratio over the medium term?
So maybe Darren, maybe you and I can both answer this question, if you don't mind. So I think the sort of, yes, the asset recycling is continuing, and there is opportunities, and we are under negotiations with some disposals or partial disposals. So Darren, you did miss the question earlier around co-investment. So asset recycling doesn't just necessarily have to take place in total disposal, but can also in partial disposal. So that has definitively been looked at. There is still some retail that does make sense in the grid portfolio. We don't see that going to zero, but we do see a dramatic reduction in that. And again, it also goes to co-investment. So we do have the infrastructure to service retail, but we don't necessarily want to own it 100%. So we do see quite an aggressive reduction of that retail. And once we put ANFA into that REIT in Morocco, because ANFA is the largest retail asset, if you just look at it from a percentage split on a valuation perspective, we will see quite a substantial reduction in retail specifically. So I think from us, from our side, just and maybe Darren, you can just touch on the distribution and dividend. We do want to get back into the world of resuming what we had put out to the market from a distribution perspective. However, even historically pre-COVID, we have said that we do want to reduce our payout ratio, because the ability to use some of our cash to actually put back into our projects, to look at enhancing acquisitions, to grow not just the distribution of the business, but also grow the net asset value of the business is quite important to us. So, we want to get into a position where we do resume and go back to an ordinary dividend cycle and dividend payout period, but we also want the ability to not pay out, as we historically have, such a high percentage of our cash out into the market. So it's just really around now the management team's task is balancing loan to value, balancing liquidity, balancing the access to cash, ensuring that we are paying out distribution, because a lot of our investors are institutional income or pension fund players that rely on distribution, and we're very cognizant of that. But we also want to enhance the net asset value growth of this business, because the Africa story, ex-South Africa, also comes in the growth story itself. So the ability to enhance NAV also becomes very, very important. And again, ultimately getting our share price to re-rate, because as it currently stands, and something we probably also haven't mentioned in much detail, at the current discount to net asset value, and there is a substantial discount, the ability to raise equity does not come in the true equity stance of going to market. So it's very important that we're able to ensure that we get the re-rating back to closer to NAV, but also look at other means of raising equity from DFIs who are strategic, looking for Africa exposure, looking for a team like Grit, because the DFIs could also look at co-investing into these structures and being able to use that type of cash to ensure the growth of the business going forward and not raising equity because of our discounts, because we don't want to do a dilutionary equity raise. So, Darren, I don't know if there's anything else you want to touch on the distribution specifically.
Sure. I think, so just 3 quick comments. I think retail, we have reduced our exposure down to what we believe is within our targeted range. So to the extent that we are, not necessarily forced sellers, some of the valuations have come down a long way. So, I don't expect us to have definitive mass exits from retail, because we still believe there's value in it, and specifically in the convenience malls in Africa. That convenience element is still a very, very attractive offering and yields a very good yield for us. So I think that's the first point. I think the medium-term aspiration for the group is still to target between a 70 and 80% payout ratio, although we haven't really given a timeline as to when we're going to get to this normalized normalized payout. If you recall, Grit has thus far, before this current sort of 2 reporting periods, has generally paid out between 90 and 100% of its distributable earnings. We have given the guidance that we believe it's probably closer to 80%, but it probably looks at between 70 and 80% as our medium-term guidance on payout ratio, because very simply, we have some really attractive developments which can yield substantially more than our current shareholder return. And so we believe reinvesting those proceeds for accretive transactions is obviously in shareholders' interest. So I think those are the rationale and the medium-term sort of aspirations for us to get to. There's a couple other questions, but I think this is quite a pertinent one, Bronwyn, if we can address. So we did a small capital raise in December, raising around $10 million. And the question is coming back in terms of how do we weigh up raising fresh capital in December versus paying out a dividend now? And maybe it's a good time and opportunity for us to just give a bit of background and a little bit of the detail around why we required that capital raise in December to help us achieve the premium listing, and obviously our thoughts going forward on that.
Yeah, so thanks, Darren. And again, if you can just sort of touch on if I have excluded anything. So just going back a step and around why we did that capital raise. So it was specifically driven around the fact of the drive and trading negotiation, which is obviously our empowerment consortium, and the renewal of the facility and extension of the facility with the PRC. Because we were still under negotiations, and because of the nature of that guarantee, which is callable in 4 days, it was quite important to demonstrate an underlying cash position for that specific guarantee. And that was to ensure that our auditors signed off our audit report, and we didn't have any challenges around any qualification around going concern and other aspects. So there was a very specific reason why we raised that specific pool of capital. So ordinarily, we've never issued shares below NAV. And ordinarily, we've never done a capital raise below NAV, but it was a key consideration for the underlying position around that guarantee. Now, we've obviously progressed since then, and we are finalizing the negotiations with the PRC around that particular guarantee, and hope to have a long-term solution quite soon, which would be coming possibly back to shareholders for approval. But that was specific to that event itself. The distribution today that we are declaring is driven around the operational performance, ultimately. And the operational performance is that since then, we've collected a very large outstanding from the hospitality sector. We continue to keep relatively high collection rates. We were able to get the LTV, which really was one of the items below the 50% mark, and the fact that we wanted to ensure that we get back, based on our operational performance, some form of dividend paying scenario back. Bearing in mind that we've put 4 key considerations or key drivers to understanding if we will pay out a second distribution quite soon to this, and that is detailed they're quite detailed in the presentation. So that's the underlying thinking. So Darren, I don't know if you want to add anything on that.
I think the only thing to add, Bronwyn, is it was a timing issue. So
Correct.
Recall, we did the premium step up, and our our numbers were only valid until the 31st of December, calendar 31st December, in which they were fresh to be utilized as the step-up process. Now, what the step-up procedures allowed was an emphasis of matter just on the uncertainty of COVID, which is what was in the audit opinion. What it couldn't allow was an emphasis of matter on potential liquidity. Now, the only reason we were falling short is that if you ran the worst case scenario, which included a phase 3 of COVID, all of the liabilities coming due at exactly the same time, we had this very small shortfall. So although it's not our base case scenario, and nobody certainly models it that way, just the pure rules and the listing rules required us to throw all this stuff into the mix at exactly the same time. And in that instance, we were a couple $2 million short. Now, as Bronwyn's alluded to, we obviously collect operational cash flows, and we're obviously now 2 months into that operational cash flow collection, and we have not seen all of the worst case scenarios simultaneously occur. So I think it's the thinking around it was very important to get it done in December, because we would have missed the opportunity to step up to premium had we not done that. And obviously it's an unintended and a moral hazard to be issuing equity at below NAV. But in the instance, it was actually unbelievably important to do it. Otherwise, we would have lost out on all of the sunk costs around premium step up and sort of other aspects around that.
Thanks, Dan.
Bronwyn, so data centers are amongst sort of the highly valued in terms of price to book ratio and sort of excitement. So there's an observation that, are we making data centers part of our plans into the future? And if so, maybe just some thoughts around the sector and possible opportunities.
Yeah, so thanks, Darren. And I think if you had a look at the slide when I presented on Greer, you will actually note on that slide that they are currently contracted and working on some very large data center opportunities. And that obviously it's not coincidental. It really goes into alignment with what the grid strategy is into the future. And obviously this is on the proviso that the capital structure itself can resolve itself from a re-rating, the ability to raise capital, et cetera, but you will see on their pipeline projects, they are quite substantial, and they're not all listed here, but one large substantial data center opportunity. So for us, we have seen resilience on the communication side, telecommunication side over the COVID period. So for example, our Vodacom asset itself in Mozambique and the renewal of the lease has proven resilience in that particular segment. But this is a very real opportunity, and our Greer team, which is obviously partners with Grit itself, are working on these opportunities. So really into the future, as you can see from their pipeline, what we're seeing from a development perspective is corporate accommodation, which you've also seen being very resilient in the Grit portfolio, very focused on American Embassy OBO type opportunities, which is really strength of counterparty paper out of the US itself, and then data centers. So definitively, yes, it will form part of our pipeline into the medium term.
And just to remind everybody, Bronwyn, I think what we have sort of communicated pre-COVID crisis, was our investment committee charter allows us to pre-fund. And so in theory, had the capital markets and funding been more abundant, Grit today could have pre-funded into some of the projects that might ultimately end up on our balance sheet. As it stands today, we have not done that. But what it does mean is that in the future, we obviously share in 20% of the development profits on these projects. And should we so wish as Grit, we can make offers on these and ultimately buy these buildings as acquisitions. But the key point to make here is that there is no obligation on Grit. There is no sort of pre-committed purchasing that's happening. And at the time, we'll still go through our normal IC processes and normal approval processes. But what it does do is it sets up this wonderful pipeline of assets we understand and assets where we've been involved in some way, shape, or form in their development, and that de-risks the whole process for Grit into the future. So we have a 20% look in right now, an opportunity to buy these, but if we so wish and if we are so able to, we can actually pre-fund some of these developments to share in those development profits. It looks like we have hit the 1 hour mark, and also seems that we run out of questions. So Bronwyn, let's hand over to you and Leon for just final wrapping up comments, and we'll then leave it there.
Thanks, Darren. Thanks. And thanks for the questions. I think they were very, very good questions. And if there's anything further, please reach out to the team who is available to take any further questions and discussions. So I think from myself and obviously from Leon and the board of Grit, we continue to be extremely optimistic and excited about the future of Grit. We haven't had to sort of change the investment strategy. So the counterparty strength, the diversification, the asset class, yes, we've had to refine it. And yes, we've had to look at different sectors and segments that we are invested in. But, you know, where the sort of world is going and the access to growth and the access to opportunity, the African continent for us is absolutely key into the future of growth. And having a vehicle like Grit, being successful in the closure of the premium listing, and really using this as a strong foundation going forward, we're very excited with obviously our institutional investors and our investor support for what we see going forward into the future. And the management team has performed exceptionally well over the last couple of months, specifically on managing the existing portfolio and ensuring we're delivering on that. So on behalf of ourselves, thank you for joining our presentation today.
Thank you.
Thank you, everybody. That concludes the call today. As Bronwyn said, please reach out at ir@grit.group for any further follow-up questions, or directly to myself, Darren, at grit.group. Thank you. That concludes the call.